The Federal Reserve has spent the last 2 years implementing a series of rate cuts, yet everyday mortgage rates are still stubbornly stuck near 7%. Mortgage pricing follows the 10-year Treasury yield, which is currently being pushed higher by global energy shocks and geopolitical volatility in Iran. When the Treasury yield stays elevated, your local bank's interest rates have to follow. This chart shows the exact cost of a 7% rate on a $400,000 home. Comparing it to 4.5% reveals a gap of over $500 monthly, a $6,000 annual penalty. That cash is diverted from your long-term wealth into interest. By treating interest as a negotiable variable rather than a fixed market cost, institutional investors and sophisticated buyers leverage the specific architecture of the mortgage system to pull their effective rates well below the national average. We're going to break down 3 legal, bank-approved mechanisms to secure a sub-market rate right now by trading capital or complexity for immediate savings. Achieving affordability in this high-rate environment requires carefully matching your personal financial leverage to the correct structural mechanism. The first strategy is for cash-rich buyers, the Assumable mortgage. This applies specifically to government-backed FHA, VA, and USDA loans. In a mortgage assumption, you take over the seller's exact existing loan. You inherit their repayment schedule and, most importantly, their permanent 2.5% to 4% pandemic-era interest rate. This chart highlights the primary barrier, the equity gap. If you buy a $400,000 home with a $300,000 assumed loan, you must cover the $100,000 gap at closing. This requires liquid cash or a secondary loan to pay the seller for their equity. Even with the cash ready, you face servicer friction. Banks have little incentive to cooperate with these transfers. Mortgage servicing companies often stretch these approvals to 90 days or longer because they lose money administering low-rate legacy loans compared to the fees generated by a new 7% mortgage. To navigate this, specialized prop tech platforms now exist to locate these hidden listings, while advocacy firms pressure servicers to comply with federal 45-day review timelines. This is a high-effort play, a lucrative maneuver reserved for cash-heavy buyers with the patience to endure intense bureaucratic resistance. For buyers with less liquid cash but growing incomes, the cooling market offers a second mechanism, the 2-1 seller buydown. Instead of negotiating a lower purchase price, you require the seller to pay a lump sum at closing into an escrow account to prepay a portion of your interest. This is the mathematical structure of a 2-1 buydown on a 6.5% note rate. In year 1, your effective rate is reduced by 2 percentage points to 4.5%. In year 2, it moves to 5.5%. By year 3, you reach the full 6.5% rate. The seller's cash subsidizes those early years, saving you hundreds of dollars each month. This strategy has become common in high-volume new construction markets. National home builders often include these buydowns to move inventory without officially cutting their list prices. Note that lenders still require you to qualify based on the full 6.5% note rate. This ensures you can actually handle the costs once the subsidy expires. You must be prepared for the year 3 payment spike. This strategy assumes your income will grow or that market rates will eventually drop enough to allow for a refinance. The 2-1 buydown is a calculated financial bridge for buyers betting on their own future income or eventual shifts in the broader market. The final strategy is for the borderline optimizer, a buyer with an average credit score who is currently paying a massive tier penalty on their interest rate. You can use a maneuver called a rapid rescore. By redirecting a few $1,000s from your down payment to pay off specific revolving debt 30 days before applying, you can force an immediate jump in your score. Crossing brackets, like moving from 719 to 740, triggers an automatic permanent rate drop. The long-term savings of this small cash redirection far outweigh a slightly higher down payment, saving tens of thousands of dollars over 30 years, without buying points. Once your score is optimized, you can take that application to a local portfolio lender instead of a national bank. Portfolio lenders hold their loans in-house rather than selling them to Wall Street, which means they can bypass rigid conventional pricing grids to offer relationship-based rate discounts. Optimizing your borrower profile and your lender selection is the highest ROI strategy available to the average homebuyer today. You cannot control the Federal Reserve, but you can control how you structure your deal by trading capital or complexity for a lower rate. Use this decision framework to match your strongest asset to the correct strategy. If you have high cash reserves, look for homes with an assumable mortgage. If you have leverage in a buyer's market, negotiate for a 2-1 buydown. If you have an average credit profile, focus on a rapid rescore. Executing any of these strategies requires a clean credit foundation to reach the negotiating table in the first place. Stop house hunting and watch our guide on the 609 letter maneuver to legally force bureaus to clean your credit report before you apply.